Good afternoon, and thank you for joining us for the International Tax Update here at Withum's Business and Finance Symposium. I'm Kimberly Murphy. I'm the practice leader for Withum's International Services team, and I'm very excited to introduce you to two new partners here at Withum. The first is Frank Landrinow. Frank is in our Houston office, and Frank will be leading up our international business tax team. And Connor Southwell. Connor is in our Los Angeles office, and he'll be heading up our international private client services. Today, we are going to provide an update and some year-end planning ideas for you. We're going to start with Connor, who will be talking about the legal landscape, what's going on. You don't often hear about legal cases involving international tax, but there have been a few. So he'll go through those as well as the fairness doctrine and how to handle penalties and what some of the options are for how to handle the IRS even when they're closed when dealing with international tax controversy issues. Then we'll go to Frank, who will be talking about what we call OB3, the one big beautiful bill, the international tax perspectives of that. He'll be getting into planning, year-end planning around GILTI, around FIDE, the former FIDE, and around BEAT. And we'll close up with Connor talking about some controlled foreign corporation issues, specifically around Section 962, the reinstatement of Section 958 before, and then the new Section 951. Don't worry, by the time Connor finishes, you'll be a code head with those code sections as well. So I'll turn it over to Frank. If you have any questions, we encourage questions. Please go ahead and drop them in. I'll be monitoring the questions, and we hope you have a great hour with these two wonderful gentlemen. Go ahead, Connor.
Thank you for the introduction, Kimberly. As Kimberly mentioned, I'm a partner in our Los Angeles office. I deal with private client issues. I also do a fair amount of international tax controversy work for both individuals, companies, trusts, whomever is penalized, subject to international informational reporting penalties. So I wanted to take my time to go over the current landscape of where the IRS, the tax court, and various appellate courts are with challenges, specifically to 5471 penalties, 5472, and some foreign trust reporting penalties that are reflected on a 3520 and a 3520A. Before I start, I will note, as Kimberly mentioned, obviously the IRS is closed right now. So if you have notices that you're trying to address initially through Service Center, good luck. They're closed. Some of the appellate offices are still open. I know that field service agents who are dealing with offers and compromise and complex audits through LB&I may be working, but it's kind of hit or miss. And I've heard that the shutdown has now extended to tax court. So if you have a petition outstanding, follow up on that, make sure that the docket has not been affected. So I'm going to scroll through these slides. So the first thing I wanted to talk about was where we are currently. And things really started to change in 2023 with a tax court decision known as Farhi. Farhi concerned the imposition of penalties under 6038B, which is 5471 penalties, specifically I believe it's category 4 and 5 filers. What that court case held was that the IRS lacks the authority to summarily assess those penalties because the penalty provisions are contained in a chapter of the code which does not bestow upon the IRS to assess them as a tax. That was great news for a lot of taxpayers who had been assessed because the first argument, or one of the arguments that we would raise to the IRS when these were imposed, was you lack the authority to impose these. Now, obviously, the government appealed that case, so most times they would push back and say it's under appeal. And as it turned out, when the case was elevated to the DC Circuit, it was actually overruled, at least with respect to taxpayers who live in the DC Circuit, which is a very small area. Following Farhi, there was a case called Mookie, which again dealt with 5471 penalties as well as 3520 penalties for failure to report distributions from a foreign non-grantor trust. Mookie raised the Farhi argument, and the tax court reaffirmed that they believe that these penalties are not assessable, at least the 5471 penalties. The taxpayer also raised an argument under the Eighth Amendment to the United States Constitution regarding the excessive fines claims, and that was in relation only to the 3520 penalties. And basically, the argument was this penalty or this fine is punitive in nature. It does not serve any legitimate interest that's related to a loss of revenue to the government, and therefore it should be struck down. The tax court did not buy that argument. Specifically, they held that this is not a fine within the meaning of the Eighth Amendment because it was related to taxable income that the taxpayer failed to report. So my question when I read Mookie was, would that apply to 6039 Cap F penalties, which is the penalty that applies for failure to report a foreign gift, which is not taxable income? The interesting piece with Mookie is that it can be appealed to the Eighth Circuit, and if the Eighth Circuit affirms that the IRS lacks the authority to impose 5471 penalties, then you'll have a circuit split between the DC Circuit and the Eighth Circuit, at which point really the only resolution would lie with the Supreme Court. At the end of last year, so almost a year from today, the tax court again reaffirmed that they disagreed with the DC Circuit, and Farhi held that they cannot assess 6038 penalties absent a judicial determination. There is a current case that has to do specifically with 6039F penalties, known as Zhang. You can look the case up if you have access to a docket system, and you can read the briefs, but it's going to be interesting to see how that plays out because that's an area where a lot of stakeholders have really pushed back and said this is a very, very punitive penalty. It has nothing to do with income. We should get rid of it. In 2020 and 2023, the taxpayer advocate came out, well, every year they come out with reports to Congress where they identify common issues that are faced by taxpayers and come up with proposed solutions. In 2020 and 23, both years they identified 5471, 5472, and 3520/A penalties as being fundamentally unfair to taxpayers. The argument was that there's no relationship between lost revenue to the government and the penalties that are imposed, and that particularly with respect to submissions to address delinquencies that are done outside of streamline, so DIRSP or Delinquent International Information Return Submission Procedures, the penalties are just assessed when you file the forms. You can submit a reasonable cause argument, but the IRS generally doesn't care, and then you're stuck in the appellate process, and potentially you end up in tax court. So they have called for reforms to these penalties multiple times. So far, nothing has happened. So what do you do, if you are assessed these penalties? What are your options for abatement? How do you disagree? What are the procedures? As I mentioned, the first one is DIRSP, Delinquent International Information Return Submission Procedures, which we always abbreviate because it's a mouthful. It used to be that when the program first came out, you would submit your returns with a reasonable cause statement, and the service center would actually consider the reasonable cause argument and decide whether to impose penalties or not. Now, generally, you file amended returns. The system automatically recognizes that the return was filed late. It's an automatic penalty assessment. At that point, you can appeal and raise your reasonable cause argument, which for the most part, depending on the facts and circumstances, in my experience, at least at the appellate level, is pretty successful. However, it imposes an additional burden and cost on the taxpayers because you have these additional administrative layers to go through. So what constitutes reasonable cause, which is the basis for abatement under DIRSP? As I think most people know, the standard that's been enunciated by the Supreme Court is that the taxpayer exercised ordinary business care and prudence, but was nonetheless unable to comply with their filing obligations. If you look at the Internal Revenue Manual and case law, that both courts and the IRS have expanded upon that and set out some specific instances of what may and may not constitute reasonable cause. I've listed a couple here. Reliance on an accountant could be reasonable cause, but it depends on the filing obligation. So there's a Supreme Court case called Boyle, which basically said that every taxpayer is presumed to know that they have to file a tax return. So if I hire someone to prepare my 1040, give them all the information and they just don't file, too bad. That's not reasonable costs. However, most taxpayers are not deemed to know of esoteric reporting requirements such as Form 5471. So if they hire an accountant, they disclose the information, say, hey, I own this company in France or wherever, and it is not reported, that's a potential argument. You relied on your accountant, they failed. Inadvertence or ignorance of the law won't work. Again, everyone's presumed to be able to read the law and understand it, particularly if they hire an advisor. Death, serious illness, unavoidable accident, or absence, that can constitute reasonable cause, but again, it comes down to the facts and circumstances. What about if you're unable to obtain records necessary to file a 5471, for example? We see that all the time. What should you do? Best practice would be to file with what you have and include a statement indicating that the taxpayers, exercising ordinary care and business prudence, and this is what they have, and they'll amend at the time. Will it get you out of penalties? It's hard to say, but it helps in that it shows that you're trying to comply. It's voluntary compliance, right? Fire or natural disaster, usually that falls under like like for example, in California where I live, there was a administrative waiver granted for everybody to file, by October 15th because of the fires. You didn't have to apply for an extension. Erroneous advice or reliance, this is generally advice from the IRS. That usually doesn't cut it. And if you call a service center and you speak to an agent, they will tell you you can't rely on this advice, right? Unless you get a PLR or some kind of written advice, you can't rely on it for your tax return. First time abatement, that was actually extended to 5471 and two penalties, I believe in 2022. But if you have just one penalty, you don't think you have reasonable cause, that's a good option. You can actually get that over the phone now, so it's rather streamlined and quick. If you have a withholding agent that you represent who paid non-residents and they had to file a 1042 and a 1042S to the recipients, and they failed to do that, there's a specific LB&I memo that lays out a procedure that you have to go through to address that, and penalties will be waived. Again, it's based on reasonable cause, so you have to have reasonable cause. You also have to come up with a processes and procedures manual for the withholding agent that basically falls on the sword, says what happened, why it happened, and how they've corrected it through, a withholding program. So we continue to see a lot of streamlined activity. That was a program, I believe it came out in 2014 or 13, so it's been around quite a while. It's predicated upon the taxpayer being non-willful, right? They didn't know they had to file international forms or FBARs. It's generally a lower standard than reasonable cause because ignorance of the law will suffice, right? It's only available to individuals and some estates. It's not available to entities. So if you have a taxpayer that's an entity, DIRSP is kind of the only option, or first-time abatement. It's important to remember that there are two versions of streamline. There's a foreign and a domestic. The foreign is for people who live outside of the US, and it is complete penalty abatement. You have to pay your tax plus your interest when you file, but no penalties. If you do not meet the non-residency requirement, you have to go under the domestic procedures, which instead of each individual form penalty and FBAR penalty, you pay what's called a 5% miscellaneous offshore penalty, which is equal to the highest balance of assets that should have been, but were not reported on a FBAR or an 8938 during the disclosure period, plus income from those assets. So it's really important to go through that analysis because a lot of times the 5% penalty could be greater than the statutory penalties, right? In which case there's no point. So with respect to streamline in the last few years, there have been a couple developments. The first came with the advent of 965, and typically you have to go back 3 years for your returns, 6 years for your FBARs. But if you had a CFC that was subject to the transition tax at the end of 17, you got to go back, calculate the tax, and do all intervening years. Um, it used to be that you could include the current year as part of your disclosure. They got rid of that. They no longer allow that. You have to go back at least 3 years. I've noticed that they're starting to really pay closer attention to non-willful statements, so it's very important to work with someone who's qualified to draft those. I generally say that the client should not draft themselves. It should always go through an accountant or an attorney. Another thing that they would sometimes overlook was a requirement that to participate, you have to have unreported income from a foreign asset. So, for example, if you had a dormant CFC, no income, sometimes they would let you file and abate the $10,000 penalty. Now you have to have income. So a lot of times clients ask us, if I file a 5471 or a 5472 without all the information, will I be penalized? And it depends on whether the form was substantially incomplete. So this is another area that's been developed through case law. I'm going to go through this kind of quickly because there's a lot there. Um, but with respect to informational returns in general, the standard is a bit higher. So the general standard is that if you file a return that enables the IRS to determine your tax liability, it's complete. However, with international returns, um, I'm reading from the slide here. Omissions on information returns hinder IRS law administration and cause returns to be substantially incomplete. Therefore, it's a higher standard, particularly with 5471s. And I just note that, one of the deleterious effects of not filing an international information return is that it keeps the statute on the entire return open until you do file, right? So if you didn't file 8 years ago, you failed to file a 5471, technically the statute's still open on that until you address it. So with respect to 5472s and 5471s, what the IRS tends to focus on, at least in some regard, is whether there were unreported transactions with related parties, right? Because that's what the IRS is primarily concerned about with those forms. Are you hiding income overseas? Are you dealing with related parties in a way that, will impair the IRS's ability to collect revenue? There are some chief counsel advice and memorandums that have held that over-reporting, particularly on a 5472, can make the form substantially incomplete or inaccurately reporting, right? So, for example, if you have a interest payment that you classify as a royalty on a 5472, chances are the form will be incomplete, right? Because the IRS lacks the information to determine what the related party transaction was. So these are some specific pieces of advice that were issued by the IRS, field service advice. I'm not going to read the number, but basically that held that if you fail to report related party transactions on Schedule M to 5471, the entire form is substantially incomplete. You will be assessed a penalty. And similarly, if you have multiple CFCs and there are related party transactions between two of them, if you report on one but not the other, they both could be incomplete. So very important to really understand your client, really understand their balance sheet and their P&L and exactly what happened between the owners and related parties. Um, in this chief counsel advice, again, the IRS emphasized that over-reporting can be something that would render a return substantially incomplete. Um, and generally what they looked at, with respect to the magnitude of the misreporting, was the taxpayer's overall business and the significance of the unreported transaction to that business, whether there was a pre-existing relationship with the related party that was not previously disclosed, and what the effect on taxable income was. Now, obviously, if you have a CFC and you don't report any income on your Schedule C and there's a ton of it, that's definitely incomplete because that has a direct effect on income. So that is the end of my time. I hope that was informative for you guys. If there's any questions, hopefully you've been sending them and Kimberly's been fielding them, but I believe you'll have my contact information at the end of this. Everyone's welcome to reach out to me.
Great. Connor, there was one question about the streamline procedure, which I answered, but I'll let you address as well, which is,
Sure.
does the streamline procedure apply just to amended returns, or can it also apply to non-filers? And I was on the IRS website, and it's available for both amended returns and delinquent returns. So even if you never filed, you can use Streamline. Thanks.
Depends on which version you go under. So if
Okay.
you're under domestic, you have to have filed a return in the past. It has to be an amended return. If you're under foreign, it can be a delinquent return. I've wondered this question before, whether you're under foreign or domestic. Let's say you're under domestic, do you have to have filed an F-bar before and you're only amending it to include additional accounts? It doesn't really say that in the guidance. It's more specific to the return itself. So you have to have filed a return. You're amending the return through domestic streamline. The F-bar issue is kind of up in the air. I would say as long as you meet the return requirement, you should go ahead and file, even if you failed to file an F-bar entirely in the prior years.
Right. Thank you, Connor. Welcome everybody to the next section of major international tax changes made by the one big beautiful bill we call OB3. Next slide, please. So we're going to go over some of the highlights. This is some of the major changes made by OB3, and we're just going to go through some of them. One is just a permanent extension of the look-through rule. We'll go over that in more detail in a second. The repeal of the election that's available for certain control foreign corporations to have a 1-month deferral in its tax year. Modifications to the pro rata per share rules. This is a rule that talks about modifications of how much GILTI or Subpart F income that needs to be picked up when there is a change of ownership within the shares of a controlled foreign corporation. We'll go into detail with modifications to FDII, the BEAT, and GILTI. Later, we'll talk about the restoration of the limitation on downward attribution and the enactment of CFC inclusion rules. Connor's going to go over that piece at the end under 958B4 and 951 Cap B. There's been some significant rules for the allocation of certain deductions attributable to the 951 Cap A category of income. That's the GILTI category of income. And then some sourcing rules that have been modified for certain income for the sale of inventory produced in the United States, but sold by foreign branches of the United States entity. And then finally, just a little bit of a recap, not going into the specifics of other domestic provisions, but some information regarding how other domestic changes within OB3 affect the international taxation issues. Next slide, please. So the permanent extension of the look-through rule, what this really is this has been a rule that's been around for a while, kept getting extended every time this legislation or tax reform comes up. Basically, it's a rule that excludes from Subpart F income, so it does not need to be picked up currently in income. Income received from related parties or CFCs that are related. And why this is important is that many of our clients have group financing transactions or transactions where one CFC might fund or provide payments for another CFC. Normally, what we've had to do in the past is to rely heavily on the same country exception, but that only applied if the two CFCs were domiciled within the same tax jurisdiction. This rule, this permanent extension of the look-through rule, is much broader and allows taxpayers to fund operations or have intercompany group financing or royalty-related payments without including those amounts in Subpart F income, which is a U.S. shareholder inclusion of income. And it's much broader because it's not dependent on any tax jurisdiction. It just has to be a commonly controlled group of CFCs. So this is good news. This is obviously very taxpayer favorable. Next slide, please. So the repeal of the election of 1 month deferral, and I don't think that many people, not too many taxpayers were relying on that, but basically the rule is that controlled foreign corporations have to have the same tax year as its majority U.S. shareholder. Very similar rule that you see with partnerships, where the tax year of the partnership has to be in line with the majority partner. There was one exception where, in many cases, you could make an election to have a 1 month deferral. This could be substantial depending on the ownership and certain conditions and transactions. And this rule has been repealed. So anybody who has had this election in effect will essentially have to have a 1 month short period filing for a CFC for the 2025 year, so that that taxpayer can get back in line with the majority shareholder tax year. Next slide, please. The next rule we're going to go into is the modifications of the pro rata share rules. Basically, the old rule was that a U.S. shareholder will pick up income, and it's only a shareholder who has ownership of a controlled foreign corporation on the last day of the year. And because of tax reform, the first version of tax reform back with under TCJA, there was a complex set of rules where you had to basically divvy up the Subpart F income. So, for example, if you were a U.S. shareholder that purchased a CFC, then you would have to pick up all the Subpart F income for the entire year if the CFC if the foreign corporation was a CFC for the entire year. And there were some other rules that said, well, that pickup by the purchaser can be reduced by deemed dividends. Deemed dividends would be including any Section 1248 amounts by the seller. So you kind of ended up with kind of an even keel about who picks up what part of income, and basically prevented taxpayers from picking up any guilty of Subpart F income for the period that they didn't own the CFC. Well, this is a more simplified rule where you count the days on a pro rata, and if you have ownership, and of course, depending on whether the foreign corporation was a CFC at the time, we'll pick up that particular shareholder's pro rata share of Subpart F or guilty income. And so that's kind of the new rule coming forward. It really kind of negates the need for all the complex evening up rules that were put into place in the first version of tax reform. Next slide, please. So the practical implication would be there could be some horse trading in deals, especially when you have a U.S. shareholder that's the seller of a CFC versus and the U.S. purchaser of a CFC, because you need to divvy up who owns which and who picks up what Subpart F income for what period. Obviously, if you have a foreign purchaser, that's it's no longer a CFC at that time, so there's really not anything to negotiate. It's really going to be between U.S. purchasers and sellers of foreign groups that are controlled foreign corporations. Next slide, please. So this is one of the biggest changes, and we'll spend a fair amount more time on this. Changes to guilty. Just stepping back a little bit, under the rules under TCJA, which came into effect basically starting in 2018, if you recall, there was deferral. If you were a U.S. shareholder, unless you had some Subpart F income inclusions, you didn't have to recognize foreign earnings until those earnings were distributed in the form of a dividend. So there was this deferral of typically of foreign earnings by a U.S. shareholder. Under the transition rules, basically, and Connor kind of alluded to 965, there was a transition to this new regime. The new regime was kind of sold as a quasi participation exemption regime in which foreign dividends under certain circumstances were not picked up into income. What we really got in actuality is an expansion of the worldwide tax system, albeit at a much, much lower tax rate. So some of the changes that, and therefore GILTI was born. GILTI was basically that a U.S. shareholder, as long as this foreign corporation was a controlled foreign corporation, that U.S. shareholder would pick up his or her pro rata share of net tested income. But there was a formula that included the tax basis of fixed assets, less net interest expense. So therefore, the term GILTI came into play, and that income was allegedly supposed to be taxed at 13.125%. So the story went that if you were paying tax on an effective rate in a foreign jurisdiction of more than 13.125%, you would pay no residual tax. As we'll talk a little bit later in this session, that ended up not being the case. There was usually at least some level of U.S. residual tax. But the change here in OB3 is to remove the fixed asset basis component, and therefore the inclusion just is net CFC tested income. So no longer is the term GILTI starting in 2026. It will be NCTI, and doesn't exactly roll over the tongue. I suspect we'll be calling this GILTI for some time to come, although the computation will be different. One of the advantages is that GILTI, the reason why you get this ultra low rate is that you get this 250 deduction, which reduces the inclusion of the net tested income to 50%. Well, without any law change, this was scheduled to go down to 37.5%, but with tax reform starting in 2026, it's now a 40% exclusion. The result of which should be, and we'll talk a little bit more about the shareholder expense allocation, but this should result in something very, very close to, if you're paying tax in a foreign jurisdiction at the rate of 14% or more, that you should be able to not have any residual U.S. tax. That's the effect of this legislation coming up with the foreign tax credit that's allowed. Keep in mind, what has not changed is if you have a net tested loss. In other words, let's say you have more than one CFC, you get one CFC that has income, another one that has more losses, and you have a net tested loss, that still cannot be carried forward or carried back. So that has not changed. What has also changed is that there was a haircut to the foreign tax credit. So foreign taxes attributable to GILTI inclusions, you didn't get the full credit. You got a haircut of 20%, and only 80% of the foreign tax credit was allowed. Now that is increased to 90%, and the combination of removing the QBI amount, which removes the inclusion, your inclusion percentage should go up, plus the increase in the foreign tax credit from 80 to 90, should result something a little bit closer to the overall 14%. As we talked about, the deemed intangible return, which include fixed assets, is removed from the equation. The reason why it was removed, that was very controversial topic, because the tax community basically said it encouraged the offshoring of fixed assets. Next slide, please. So one of the most important provisions, which is really interesting, is that at the shareholder level, the U.S. shareholder level, the owner or the shareholder of a controlled foreign corporation did have to apportion expenses that were attributable to GILTI income or these GILTI inclusions. Some of these expenses included interest expense, R&D expense, stewardship costs, other types of costs. And that is primarily the reason why there, even despite the 250 deduction and the 80% foreign tax credit, there was usually some level of residual U.S. tax liability once you even credited the foreign taxes. Well, this provision should help a little bit to get closer to that 14% because under 904B5, no interest expense and no R&D expense is required to be apportioned to your, this is for purposes of determining your net foreign source income under the GILTI foreign income tax basket is not to be applied. What is applied is the 250 deduction, state and local taxes imposed on 951 Cap A, which is the GILTI category or the NCTI category now, as other words, and any other direct allocable expenses will be allocable to the NCTI basket. Other deductions that were formerly allocated to this 951 Cap A basket will now be allocated to U.S. source income. What's interesting is a lot of opportunity here. There is some authority in certain areas of the code that talk about what is directly allocable, but it's likely we'll need some guidance from Treasury before the end of the year before we can start implementing and knowing exactly what is considered directly allocable to take advantage of this. Next slide, please. So some of the planning strategies. So now we no longer have that fixed asset piece that was always exempted from the GILTI inclusion. So this becomes more important. There's something that has been out there called the GILTI high tax exception. What it basically is that it was never meant to tax foreign income here in the U.S. that's adequately taxed elsewhere. So basically, the rule is that you have to compute income on a U.S. tax principles basis and basically do a formula that what are your foreign taxes and then divide that into a ratio. And if your effective tax rate using U.S. tax principles ends up being 18.9% or more, that's roughly 90% of the corporate tax rate of 21%, then you can exclude that amount from the GILTI inclusion. That's very, very powerful because it becomes 959C3 earnings and profits, which when distributed, if you're a corporate shareholder, is eligible for the 245 Cap A dividends received deduction. If you're an individual, then you should, assuming you're operating in a treaty country, you should be able to get the qualified dividend rate, which is 20% as opposed to your effective ordinary income rate. So there should be some more analysis. If you haven't been really taking effective use of the high tax exception, it might be time to take a more closely look at this. The other thing that's also something probably not used that much is that the net tested income or GILTI inclusion, as it's called right now, is determined as if the controlled foreign corporation were a domestic corporation. So what that means is that, a lot of taxpayers do method changes for their domestic side. A controlled foreign corporation can make an accounting method change. So if there could be some more accelerated deductions, like, for example, prepaid insurance, which is deducted when paid rather than over time covering the period of the insured, you can take a look at and start looking at how you can maybe accelerate deductions, deferring inclusions, and different types of things, just as you would for a purely domestic company, and start taking a look at your accounting methods. Another thing to take a look at, if you work closely with your foreign advisor, there may be some opportunities to narrow the gap because of GILTI, the two things: net tested losses are not carried forward or carried back, and the taxes attributed to GILTI, now NCTI, is not carried forward or carried back. It's a use it or lose it system. Then you may want to match up the earnings and income based on U.S. tax principles and see if you can more closely align them with your foreign tax principles. There will always be some gap. There's always a gap in the taxable base between the two jurisdictions, but there may be some planning opportunities to look at to close that gap. A further planning idea would be to analyze your foreign taxes. A lot of times people don't really take a look at, there may be more foreign taxes than what they think they have. These have to be creditable taxes, and they're not necessarily taxes paid if you are a accrual basis taxpayer. It is taxes accrued. And so take a look and see if you're fully taking advantage of the creditable taxes under this basket. And then last but not least, analysis of your shareholder expense apportionment so you can maximize the GILTI basket of foreign source net income. This way you don't leave any foreign tax credits on the table. As I said, it's a use it or lose it system under the GILTI basket. So if you don't lose it, you don't have an opportunity to carry them forward. Next slide, please. One of the tax favorable provisions is, as Kimberly mentioned at the top of the hour, FDII, which now kind of has a little French accent. It's FDII. It's basically income that is earned through sales, lease, and there are other items in there. Qualifying income that is, you have to have a foreign customer, foreign purchaser, and has to be for foreign use. What's different is from, let's say, other previous incentives like the IC disc, the property does not have to be manufactured in the United States. So it can be a pure distribution operation in the US, and you can take advantage of what will be the FDII. It's how do you get to this really lower rate is that you get this 37.5% deduction. It's going to lower to 33.34, resulting in, again, you can see how they kind of mirror the 14% between GILTI and FDII, to get a 14% rate. That's a permanent savings. 21 less 14. That's your permanent savings you can have. It is limited to C corporations, so S corporations and partnerships do not get to use this. So that might be something to take a look at if you have significant foreign sales of qualifying property. What they have removed, just very much like the GILTI, to make GILTI NCTI, they've removed that fixed asset component where the DTIR was a reduction of your qualifying amounts that could qualify for this eligible income. This is taxpayer favorable because now you can have a FDII amount that's bigger than what your FDII amount was, since your amounts don't include the removal of domestic fixed assets. One thing that's very important, kind of a corollary to that 905B provision we talked about, but unlike the amount for GILTI, the provision for GILTI was to reduce expenses for purposes of determining what your foreign source net income is, in determining what your eligible credit would be. This is actually more direct. This is actually reducing your expenses allocable to FDII so that you get a better FDII benefit. So one of the things that we'll talk about is that they removed is things like interest expense and R&D expenses. That's under the new law. It is not included in reducing your DEI, which is your derived eligible income, in arriving at FDII. So again, very taxpayer favorable. And we'll talk about some planning ideas on the next slide. Next. So with FDII planning, if you have quite a bit of foreign sales, it doesn't have to export sales typically, but with foreign customers, there are three components we're really kind of saying that you can really take a look at in kind of taking a look at your you're planning for FIDE. First of all, identify all your sources of FIDE. A lot of times people overlook what is qualifying. There are some documentation requirements, so you do need to be able to prove that the purchaser is a foreign person and it is for foreign use. Um, so that's definitely something you need to take a look at, and just kind of dig into your general ledger and see if you're identifying everything. So a study is warranted, for that purpose. But probably some of the most, because of the changes I just discussed, some of the more potent planning ideas is to analyze your costs. So the advantages could come from two different directions. So in determining your FIDE, you take your foreign derived eligible income, and from that you reduce your costs. But there are allocable costs and there are apportionable costs. So your allocable costs are costs that are directly attributable to that income. It's basically costs that you've incurred that directly generates that income. So if you didn't spend this money on salaries, wages, or goods, you would not have derived this income. So that's that very direct connection. Make sure you have identified that properly, and dissect your P&L so that you can really zero in on your direct costs for foreign derived eligible income, so you can come up with your FIDE. The second piece is in the apportionment. Uh, so that warrants a review of your 861 cost apportionment method. So most of my clients by default will apportion mixed costs, general administrative costs that are not directly attributable to any specific income, and you apportion them based on gross receipts. And they kind of stop there. But there could be all under 861, you can use all kind of methods. You can apportion it by cost of goods sold, gross margin, or even 861 says any other method that would result in a closer connection between the nature of expense and how it's derived. So this is a big opportunity to take a look at your apportionment. The thing to keep in mind with this 861 apportionment thing is that if you have other operative sections, so for example, if you have an IC disk also with some of this, if you have for your foreign tax credit computations, you have to use the same 861 method for everything that you apportion costs for in the international arena. But the positive part of it is that changing from one 861 method 1 year to the next is not considered a method change. So you can say I'm going to portion my indirect costs by gross receipts in 1 year, and then change it up to I'm going to do it based on gross margin the next year. And that's not a change in accounting method because it does not change the nature or the timing of the cost. So keep in mind, this is a powerful tool, but the devil's in the details, and how much time you want to spend into you can derive some very nice benefits. Next slide, please. Just a light discussion. We're not going to go too much into BEAT, usually for very high taxpayers, but the BEAT rate has moved from 10% to 10.5%. Earlier this year, the international tax community in particular was rocked by 899, thinking that this would come into play. This is a provision that basically said if you're a foreign country that imposes these quote unquote unfair taxes like the digital services tax or the top-up taxes that many are implementing under Pillar 2 legislation, the United States was going to impose an incremental 5% tax, or up to 20%, on any foreign taxpayer that has U.S. source income, effectively connected income, or portfolio income. And that was the fear was that it would curtail foreign investment into the United States. And so it was averted by a last minute agreement and where it stands now is that the G7 has an understanding that the US system will exist side by side with Pillar 2, where the OECD has a problem with our version of Pillar Two, which is basically guilty, the NCTI, is that you can cross credit amounts from different countries. You can, in determining guilty, it's a shareholder computation where it's a net tested income. It's not a CFC by CFC inclusion. It's a shareholder calculation, which is very different from Pillar Two computations, and they're not really sure they like that very much. So stay tuned for this. I don't think that we've seen the last of the Pillar Two discussions. Next slide, please. So this is kind of a little, kind of an obscure, but yet important, depending on your fact pattern, provision. Basically, tax reform back in 2018 changed the old sourcing rules for inventory. Depending if inventory was manufactured, it was purchased, and basically it was kind of a 50-50 rule where 50% was sourced to where the inventory was produced and 50% where the title passed. Tax reform, the first tax reform back in 2018 got rid of the title passage rule and basically said if it became a production nexus type of rule where if the inventory is 100% produced in the United States, it was 100% sourced to income, to U.S. source income. The problem with that is that many U.S. Taxpayers were selling their goods through foreign disregarded entities, foreign branches, where they were paying tax in the foreign jurisdiction. So the foreign branch would be paying tax in a foreign jurisdiction and had no foreign source income in the United States from which it could take a credit. There's no foreign source income, credits cannot really be used in the United States. So this is really more of a fix-it type of provision than anything else. Next slide, please. And just finally, some of the provisions that I didn't want to, this is not really international tax provisions, but this is something to be cautious. And modeling is, you may have heard this throughout the symposium, modeling is very, very, very much needed. So please get someone, a tax professional, working with us, Withum, to work with you on these. So as you probably heard from other thought leadership and other Withum webinars, is the return of the 174 CAPA expensing. And then in this transition period, you could actually double up. So for example, in 2025, now that you have the idea that any kind of unamortized balance from previously capitalized amounts in the 174 can now be expensed immediately, depending on if you're a small taxpayer. You could have done it perhaps in 2024, but a lot of taxpayers are doing it in 2025. And then, of course, you get to expense 2025 as well. So you kind of have a little bit of a double dip in your R&D expense deductions because you're transitioning from one regime to the other. And so if you do decide to allow the expensing, I think this is outside the scope of this presentation of what some of the options are, but if you do decide full expensing, then you could result in some unintended consequences. One would be if you are subject to BEAT, doubling up on R&D could cause additional BEAT tax because you have a lower regular tax liability. Another thing is that 250 deductions in determining, guilty or even the FDII deduction, because you can get 250 deductions either way, is dependent on having taxable income. So if you have no taxable income, if you have a loss, for example, there's no 250 deduction for guilty, and you cannot take your FDII or now FDII deduction. So that's something to be careful of. Because the rules under the foreign tax credit limitation issues is that, so for example, if you have a U.S. domestic loss for the year, you have to reduce in the current year your bucket of foreign source income. And so that could result in not being able to take the foreign tax credit in a particular given year. And if some of those credits or foreign tax credits related to the guilty basket, then those foreign tax credits are lost forever. So kind of do some modeling to make sure that whether you want to immediately expense your R&D, or do you want to do something else under other method changes? So some other changes that were to occur is changes in the 163J. Previously, if you made the group election, basically where you compute the 163J limitation for a CFC group instead of CFC by CFC, if you elected that group election, you could include subpart F or NTCI in the 163J calculation. Well, after 2025, you can no longer do that in determining the 30% limitation computation. And then the final thing is they clarified that the Section 245A deduction, which is the deduction for dividends received, that's the foreign source portion of a distribution from a foreign corporation that is at least 10% owned by a corporate shareholder, and the 250 deduction is excluded in computing the 30% limitation. So those are some of the international components of some of the domestic side issues. Next slide, please. Now I'm going to throw this back to my colleague, Connor Southwell, who's going to some very interesting and beneficial planning for individuals under Section 962.
Thank you, Frank. So most of what Frank was talking about with respect to the 250 deduction and the Section 960 haircut on a foreign tax credit when you have a GILTI inclusion, those rules apply to corporate shareholders of CFCs. But obviously, you can be an individual shareholder of a CFC and still have a GILTI inclusion, or for that matter, a subpart F inclusion. Obviously, the tax rate that individuals pay is higher than a corporation, and you don't get the benefit of those deductions in the foreign tax credits. So Section 962 of the code, for the purpose of computing GILTI and subpart F, allows an individual U.S. shareholder of a CFC to be treated as a domestic corporation. What are the benefits of that? Well, obviously, you get a reduction in the tax rate, right? You're taxed at 21% instead of graduated rates up to 37%. You also get to claim indirect foreign tax credits relative to the income inclusion under GILTI or subpart F. Now, as Frank mentioned, it was an 80% allowance for GILTI. It's being raised to 90%, so it's not a full credit, but it is still very valuable, particularly for inclusions from CFCs that are in a jurisdiction that does impose a tax, but not quite enough of a tax to qualify for the high tax exception, right? You can also qualify for the Section 250 deduction, right? So you get to exclude what used to be 50%, now it's 40% of the income inclusion. When you factor that into the new allowance of the foreign tax credit, if you make a 962 deduction, roughly it brings your tax rate on net tested CFC income to 12.6%, right? So that's much better than paying 37%, right? What are the burdens? What is the cost of making a 962 election? Well, as a general matter, when you have an income inclusion under subpart F or GILTI, those earnings become what's called previously taxed earnings and profits, or PTEP, as we call it. The purpose of that is such that when the income is subsequently distributed, it's not going to be subject to a second layer of tax. In other words, tax as a dividend. If you're an individual shareholder and you don't make a 962 election and you have an income inclusion, the entire amount of the earnings from which that income inclusion stems will be PTEP. You can thereafter take it out, no additional tax. If you make a 962 election, the entire amount of income does not become PTEP. Only the tax that you paid pursuant to the 962 election is PTEP, meaning you can take that amount out without an additional tax, but the rest will be taxed as a dividend. Whether that dividend is eligible for qualified dividends rate depends on whether the foreign corporation that pays it is a qualified foreign corporation, right? And that's Code Section 1H11, I believe. Basically, that corporation has to be organized in a treaty country, and it has to satisfy the limitation on benefits provisions in that treaty, whatever it is. Another cost or something to consider is that this is an annual election, and if you make it, it applies to every CFC you own. So you can't make it on some and not on others. It increases compliance costs because now you have to track E&P in order to be able to account for your PTEP. You have an 1118 to file instead of an 1116, right? Because you have to account for your allowable foreign tax credit. And really, before you make it, you should model it out because every circumstance, in fact, is different, right? What may be good for one client is not necessarily good for the other. You really have to consider the business objective, the tax rate in the foreign country, whether they're going to take profits out, stuff like that, so you can get an accurate picture. So these are some of the general considerations that we employ when we're doing that analysis. The first one is obviously if the CFC qualifies for the high tax exception or exclusion, there's no point in making a 962 election because you're not going to be taxed, right? The second one is look at the income. Is it GILTI? Is it subpart F? Like I said, GILTI, you get these added benefits. You get a 950 or 250 deduction. You get a 960 credit. So it brings the rate down substantially from 21% to 12.6. If you have subpart F income, you don't get a 250 deduction. There's no such thing. So your tax rate will be higher, although lower than if you were taxed as an individual. Was the CFC subject to any foreign corporate taxes, right? That credit becomes really valuable if it was. If not, if it's in a low tax or no tax jurisdiction, that's a very minimal benefit. Obviously, you still bring the rate down just because of the differential between corporate and individual rates, but you got to make these considerations. Perhaps most importantly, what I look at is, are there going to be distributions in the future? And if there are, what portion of those distributions will be PTEP? What portion will be non-PTEP? And what will the tax be on that non-PTEP portion? Is the CFC organized in a treaty jurisdiction? If so, you get a 23.8% rate, depending if you're subject to NIT. If not, it's ordinary income. Now, obviously, if you have a U.S. shareholder of a CFC and they're like, we're never going to take the money out, this is going to be sold down the road or whatever, then a 962 election looks like it makes a lot of sense, right? Because instead of paying 37%, say, on phantom income, you can bring that down significantly. Again, you have to look at the shareholder's entire picture. How many CFCs do they own? Does it make sense for every single one of those CFCs? Do they want to do it year to year? And by the way, you don't have to. You can make an election one year, not the next year. But all stuff to consider, right? So I'm going to move the discussion back to OB3, which, in addition to everything Frank talked about, it reinstated Section 958B4, which was and now is a constructive ownership operating rule when determining who is a U.S. shareholder of a CFC. What 958B4 says is that it basically turns off downward attribution. So we don't have a diagram here, but I'll try to visualize it. I'll walk you through it. So you have a foreign parent, and underneath you have a U.S. sub and a foreign sub. And then on top of the foreign parent, you have a U.S. shareholder, could be a corporation, could be an individual, trust, whatever. They own at least 10%. Under 318, downward attribution would take the shares in the foreign sub and attribute them through the foreign parent back down to the U.S. sub, meaning U.S. sub now owns 100% of foreign sub. U.S. sub has a filing obligation. They do not have an income inclusion because they are a constructive shareholder. But the guy at the top, maybe unbeknownst to him, now has an income inclusion, right? Because he's a U.S. shareholder of a CFC. So a lot of people freaked out when 958B4 was repealed by TCJA with good reason. I think that, and we'll get into this in a little bit, what Congress was really trying to target was a specific type of corporate transaction called a decontrolling transaction, where basically you have a similar setup. foreign parent, U.S. sub, foreign sub. But typically, the foreign sub would be a wholly owned subsidiary of the U.S. sub. So to get around that, they would structure it so that the U.S. sub had a 10% interest in the foreign sub, and the remaining 90% was owned by the foreign parent. That would make sense. The repeal of 958 before would make sense in that situation because you're circumventing the entity deferral rules. In the typical example, which I just walked through, it doesn't make a lot of sense. It doesn't achieve the statutory and the legislative purpose. So how did Congress reinstate this while targeting these decontrolling transactions? The answer is they enacted a brand new code provision called 951 Cap B, right? And again, we don't have a diagram, but try to visualize that setup, foreign parent, U.S. sub, where U.S. sub owns a minority interest, say 5% in a foreign sub, and the rest is owned directly by the foreign parent. So it applies to foreign controlled U.S. shareholders, which in my example would be the U.S. sub that are owned by a foreign parent, of a foreign controlled foreign corporation. That is the foreign sub, which is predominantly owned by the foreign parent. 958 Cap B will attribute the stock owned by the foreign parent to the foreign controlled U.S. shareholder to determine if that shareholder is required to include amounts under Subpart F or guilty. What is a foreign controlled U.S. shareholder? It's any U.S. person who owns more than 50% of the stock of a foreign corporation. You make that determination by applying the downward attribution rules. So 958B4, in other words. A foreign controlled foreign corporation is a foreign corporation, which is not a CFC, right? Because in my example, it's 90% owned by a foreign company, which happens to be owned constructively more than 50% by a foreign controlled U.S. shareholder. All this is a lot of technical terms, and I encourage everyone to, if you have clients that this may apply to, there's a lot of good resources online, honestly, and I think we actually have some material out there that'll illustrate this, with simpler examples, and you can actually visualize it. So final note, a foreign controlled U.S. shareholder is only subject to income inclusions if it owns stock in a foreign controlled foreign corporation directly or indirectly, right? So in my example, they own it directly, that 5%. So another indirect effect, which obviously we haven't seen, but we may see next year, from the repeal or the reinstatement of 958B4 is that foreign corporations, which may have been CFCs post TCJA prior to 2026, could now be PFICs, right? What is a PFIC? It is a foreign corporation that is not a CFC, who the income of which is predominantly passive, right? And or the assets are used to generate passive income. And passivity in this case is defined by reference to 958 or 954, includes stuff like dividends, anything that would be foreign personal holding company income, dividends, interest, rent, royalties, stuff like that. So if you look at the diagram we have here, this is the typical setup where you would have a 958B4 issue prior to OB3. You have a foreign parent, 10% owned by a U.S. shareholder, which owns 100% of a foreign sub and a U.S. sub. These shares in the foreign company are attributed down to the U.S. company, making this foreign sub a CFC. We get rid of 958B4, we cut off that attribution, right? Now you have a U.S. person indirectly owning 10% of a foreign corporation, which is not a CFC. If this foreign corporation, in my example, they operate a passive real estate business, not active, it's all passive rental income and capital gains from the disposition of foreign property. That's PFIC, right? Why is that a problem? Well, depending on how you look at it, the taxation of PFICs can be as onerous or more onerous than a CFC. I'm not going to get too far into the different regimes under which PFICs are taxed, but The general rule is that if you own shares in a PFIC and you receive an excess distribution, which is a distribution which exceeds 125% of the average over the 3 years, it's taxed as ordinary income. It's thrown back to every day in your holding period. There's an interest charge imposed on top. You can elect out of that by making what's called a qualified electing fund election or QEF election. Basically, what that does is it treats the foreign corporation as a partnership, and you're paying tax on phantom income, although you can elect to defer it, right? So this is basically what I just walked through, prior to the reinstatement of 958B4. In that prior diagram that we created, that foreign sub would be a CFC. Now it's a PFIC. Because of this CFC PFIC overlap rule, which provides that a corporation's not a PFIC at any time that it's a CFC. Well, if it's not a CFC, now it's a PFIC. So what are the options for a U.S. shareholder if they do not want this to apply? Again, we don't really know. All this is speculative. None of this actually happens until January. But I think that we'll see some iteration of these three potentials that I've laid out. So the first one is that the foreign shareholders of the foreign parent could agree to hold their interest through a U.S. partnership, right? Meaning that 100% of that foreign sub is going to be owned by a U.S. person, the partnership, turning that into a CFC. The 10% U.S. shareholder on top is now a U.S. shareholder for CFC purposes. They pick up their portion of GILTI or Subpart F. You could also have the U.S. shareholder purchase shares from the foreign shareholders so that they own more than 50% of the foreign corporation. Then it's just a CFC by design, right? It's directly owned more than 50% by U.S. shareholders. You could potentially leverage the options attribution rule, which says that if you own options in a corporation, you're deemed to own these shares endemic to that option, right? So have your U.S. shareholder purchase options from the foreign shareholders to buy enough stock to make the foreign sub a CFC. There is a rule that says if you use options with the principal purpose of causing a related party with respect to a CFC to basically to avoid those rules, then the option attribution rule does not apply. The IRS could attack that as a sham transaction or basically step everything together and say, this is a PFIC, right? This is an artifice that you've created because of the potentiality that, now that 958B4 is reinstated, what used to be a CFC is now a PFIC. You don't want a PFIC, so you've constructed this thing to make it look like it's still a CFC. And I believe that is the end of our presentation. So thank you, everyone.
It is. Thank you so much, Connor and Frank. Frank, I have a quick question that I wanted to refer back to on FDII, which is that you talked about analyzing all of the different types of foreign income. Can you just kind of give us a little bit of detail around that? Like, I know what types of foreign income, everybody automatically thinks of you're selling product abroad, but there are numerous other types of foreign income that could be eligible for FDII or FDII.
Yeah, the most obvious is inventory, and that's really kind of the thing that comes to mind. But it can include some services income too, and it could also provide. It's also lease income. So if you, let's say, lease something, and it can involve intercompany transactions. So you could be leasing it to a foreign related party, and that's okay as well. So that's where some of the people kind of miss picking up some of those, and it can add up. You kind of look at a few of those, and it can add up to another 5 to 10 million in gross receipts.
Yeah, I just wanted to point that out, that you automatically think inventory and product, but there are other sources of truly foreign source income. Thank you so much, you two, and thank you to all of our participants. If you have any other questions, please do not hesitate to reach out to us, and we would be happy to answer any of your questions. We truly appreciate your joining us today for this International Tax Update.
Thank you, everyone.